All right, we're just getting started. Thank you so much for joining me. I'm Mitch Goldberg. You're watching your post-market show every day at 4:30, Monday through Thursday. Or maybe I shouldn't say every day. Every Monday through Thursday, we do the show. It's a post-market show about personal finance, investing, giving you the benefit of experience of overcoming challenges, of making mistakes in the world of finance, personal finance, watching customers do this, watching myself. And I just share this stuff with you all in order to help you take control of your money. That's why the show is called Be the Boss of Your Money. I want you to be better with your personal finance. One of the things we talk about mostly here is investing, because if you don't invest, you you really don't have much of a shot of achieving your financial goals. And that's what we're here for. We're here to retire, send kids to college. But I'd say retirement is mostly the big goal. It's not just getting to retirement. It's what do you do with your money after you retire. It's there are changes that you make with your money as you get closer to retirement, as you reach retirement, and as you pass retirement. It's not just about throwing all your money into a money market and just dividing it by 20 and hopefully it'll last you for the rest of your life. There's a lot more to it than that. But there is a lot of crap out there. And one thing I do here, I think I do it well, is I rip the stuff apart. I go through the junk because there's a lot of hucksters out there that are trying to sell junk. They're trying to either sell you by hitting the greed button or the fear button, and I don't like it. And there was just an awful lot of junk being peddled late 2020 through 2021, and it's finally come to an end. And it's a hard ending, and it just seems people have to learn all by themselves every generation. But we had a big rally last week. S&P was up about 6.5% last week. Nasdaq up about a little over, just about 7.5%. Dow up about 5.5%. So really good, solid bounce back. The S&P is off something like I think it's off like 17 or 18% since its peak. It was down 23% at its worst point. That does not mean we are necessarily out of bear market territory, but I also want to tell you that you cannot invest directly into the S&P 500, into an index, for example, but you could invest in a security that tracks or mimics an index. So we're going to talk about that. I want to review the SPAC ETF. SPAK is this ticker symbol. I did a whole show exposing that a long time ago, telling you about the risks associated with it and my general feeling that it would be a disaster for investors. And unfortunately, it happened. And we'll go back and look at the record to see where I was. We'll talk a little bit about the market and why it was last week's rally a real mark in a reversal of the bear market that we've been in, meaning when the market generally has a strong downtrend. Or is it just a rally while we continue to go lower in the continuing life of this bear market? I think it's the latter until proven otherwise. And manufacturing came out today. Manufacturing figures continue to go down and, does not bode well for the economy. A lot of economists are saying we could hit a recession. We probably will. Odds are high. I think we're there already. And even if we're not officially in a bear market, knowing or feeling like we're going into one, expecting one, you might as well be in a recession, at least for your own personal finance reasons. So let's roll a quick intro. We've got a couple of things to go into. It's going to be a quick show. I got to be somewhere in about a half hour. So here we go. All right, thanks so much for getting back to me. I really appreciate your taking the time to watch this. And while you're watching, if you have any questions, please hit me up in the comments. I love hearing from you. It's the best part of doing this whole show. I really love that. And I want to give you great information. So if you actually have questions for me, that really does raise the odds that I will be covering topics that are important to you, right? Uh, if you want to give us a thumbs up, a heart, some kind of reaction, depending on which platform you're watching from, I'd really appreciate it. We're broadcasting to YouTube, Twitter, Facebook, and LinkedIn. I'm also on Instagram at InstaMitchG. So I post a lot of the highlights there. I post highlights all over the place. So connect with me depending on your favorite platform. If you have any words of wisdom or words of encouragement, hit me up in the comments for those too. Again, I love hearing from you, and I always look forward to that. So let's get back to the subject at hand. I see some people are out there. I can't tell who you are, though, until you give me a like. Don't be bashful. And if you're someone, I'm just going to say, if you're someone whose name starts with an L, I was actually thinking you should start your own live stream. You'd be unbelievable at it. A mental health focused live stream. You talk about things like medications and all these things. It's just, you'd be great at it. So I'm going to skip now over that to let's go to the tape. Pop myself up here. So we have Peter's out there. Thank you, buddy. What we have going on, I just got to say, hey, Mitch. Hey, buddy. So good to see you. Thank you, my friend. Dow down 62. The Dow is up over 800 points this past Friday. So being down only 62, in my book, that's a victory. Okay. So that doesn't mean the bounce we had last week is over. Markets were barely down today. NASDAQ off 83. No big deal. S&P off 11. Again, these are small little givebacks after a really big rally last week. I'm actually impressed that the major averages held up this well. Oil continues to climb a little bit, up $2 to 109 a barrel. The 10-year yield climbed a little bit. The VIX is under 30, 26.95. That's bullish. Okay, that is a bullish indicator when the VIX goes down. That means professional investors are starting to pay less money to hedge their portfolios, which means there's a little bit more optimism in there. Let's take a look at the yield curve, okay? So very short-term rates went down a minuscule amount. And when you get into the longer-term rates, like the 10-year, the 20-year, and the 30-year, interest rates went up. Those are bigger market drivers than the very short-term rates. So this put a little bit of pressure on stocks. I don't think it put a lot on them. I want to show you a headline real quick, okay? SPACs wipe out half of their value as investors lose appetite for risky growth stocks. Big headline today, okay? I wonder if they're going to show some of the SPACs. Okay, SPACs. You see this chart? 80 down to 40. All right. That's a disaster. All right. So a SPAC is a special purpose acquisition corp. I really don't want to get so into what that means, but well, instead of going public through an IPO where you have to issue a document, a prospectus with lots of numbers and risk disclaimers and a complete set of financials, and they have to be accurate, okay? You could go public via SPAC, where investors will raise a couple of $1 million, okay? And they, lots of money, and they will have a SPAC. It's a stock on the stock exchange. It has nothing but cash in it, no operating business. But its purpose is to acquire another business, which is why this business is called a special purpose acquisition corporation, because it's going to make an acquisition. And it wants to buy a publicly traded company. And if it doesn't have enough money to buy a publicly traded company, it could always issue a lot more stock, a lot more SPACs, usually $10 a share, to raise more money to make this acquisition. And these just became all the rage in the last year and a half, where so many companies were going public via SPAC. A lot of EV, electric vehicle type companies were going public via SPAC. DraftKings, there's so many SPACs. And, my sense is there's a lack of disclosure in these things, or not enough disclosure to make accurate assessments. These are for companies that are pretty speculative. And when a SPAC raises money, they typically have 2 years to make an acquisition. And the longer it takes, the closer they get to that 2 year mark, the more pressure the management of the SPAC is going to be under to make an acquisition. Otherwise, they have to give the money back to shareholders and they stop collecting fees. They don't want to do that. So they get desperate and they eventually will do anything and buy anything as in a SPAC. That's what I've been saying. That's what I've been saying. So the SPAC ETF from a fund company called Defiance, okay, went out today, closed at $13.74 from its IPO price of, I think the IPO price is 25, but it was as high as 26. So they've lost half their money. But again, we SPACs wipe out half of their value as investors lose appetite for risky growth stocks. SPACs are up there with like the meme stocks. A lot of the work from home, stay at home pandemic stocks. That's where they are. So I want to show you this because this is the type of work that we do here. This is the kind of research that we do here. It's the kind of thing that you should be familiar with. So let's take a look at this. I just downloaded a video. Here it is. So check this out. Here's the tear sheet on it, the fact sheet. Companies that'll be in it: DraftKings, Clarivate, Vertiv Holdings, Vivint, Smart Home, Open Lending Corp. These are all SPACs. And I think that you need to really be careful. This has just become very popular stuff. But I look at this as a sign that because interest rates are so low, it's gotten a lot easier to raise money for aggressive / speculative ventures. SPACs are like blind pools. That was a real big term in the 80s. And a lot of people got hurt with these. You're not buying Procter and Gamble and Disney and other high quality stocks. You're buying what I think could be very expensive assets because these SPACs have to pay up for the assets. They've got cash burning a hole in their pocket. And I think that what the Federal Reserve has done is that they're really good at getting money to move from one area in the market to another and creating these bubbles and bursts left and right all over the place. So buyer beware. I can't stress that enough. All right. Anyway, that was when I was talking about the SPAC ETF from Defiance. That's the name of the company that sponsored it, and it was just a unmitigated disaster for investors. So this is why I really constantly push plain vanilla type of investments. I want to talk a little bit about some of the things that I'm doing for myself. All right. Now, just so you know, we've been in a bear market, market's going down. I have not tinkered with my portfolio while the market's been going down. I don't really change things because I invest for a certain reason with a certain mix of different investments and asset classes. And I let it work over time. And I full well expect that we are going to have down markets where my portfolio could go down a pretty significant amount. And then I expect I'll recover from that. I don't know which times the market's going to go down and which times the market's going to go up in advance. I certainly don't believe in attempting to get out of the market because I think the market's going to go lower and then get back in because I think the market's going to go higher. Now, you might think that makes a lot of sense. Why not? Well, show me someone who's done it consistently because you could be right 20 times, but if you're wrong one time, you basically blow up the gains that you had from the previous 20 times. And people think they're going to get out of the market when things are and get back in, right? When things are better. When things are better, usually it means the market's higher. When people get out of the market because they don't like the market and they want to get in lower, they never do it because they procrastinate. the market's going to go back up, right? But now if it goes lower, you think, it's going lower. Things are bad. I'm just going to wait. And then the market rebounds, and you say to yourself, I could have had it lower. So now I'm definitely going to wait till it goes lower again. And then when it goes lower again, you're scared and you think it's going to go even lower. It just becomes endless procrastination. I just want to invest, put my money aside. I really don't have the time and patience to just manipulate my account all the time. But I do have cash on the sideline because I accumulate cash, and I want to share with you something that I think is a really good idea. There's something called a below the market buy limit order. So let's say you like a stock at $150 a share. Stock goes down, it's down to 140, 130, 120, 110. Maybe now it's 120 because the stock market rebounded last week. And maybe I want to buy more of that stock. If I'm going to rely on if it's not going to happen if I'm going to rely on my mood or when I think it's a good time to buy or something like that. What you have to do is use a disciplined strategy. So, excuse me, a disciplined strategy. Wow, cracked over there. And a disciplined strategy would be something like this. If I bought a stock at 150 and it's 120 now, and maybe I'm worried it'll go lower, maybe I'm not. I'm probably not really worried because I still own the stock, right? Maybe, what I'll do is I'll put a limit order in and I'll buy maybe, let's say 10 shares, 40, 50, 100 shares, whatever your dollar amount you're comfortable with. And I'll put a limit order at, let's say, 110 for 20 shares. And I'll put another limit order to buy another 20 shares if it hits 100. And I'm actually using below the market buy limit orders. I'm actually setting prices in advance of what I'm willing to pay for a stock or an exchange traded fund that are below the market. So if the market dips, I feel I'm getting a bargain. I feel I'm buying on the cheap. I know stocks will go even lower, but at least they were cheaper than they were before. And I feel that this adds discipline because if I'm relying on myself to just say, when I see it go down enough, I'll pull the trigger. You never do it because it could go lower, it might bounce back. You don't know, and you don't do it. Your brain, your mind, your mind screws around with you. Your mind says, don't do it. It could go lower. You should have done this. You should have done that. The mind is not a good thing when it comes to investing. The mind tells you to do the wrong thing. The mind is always about fight or flight. And investing, it's always about the opposite. So by having the buy limit orders in advance, it gives me the discipline to do what I logically think and said that I would do. That's why limit orders are such a great tool to use. And you could do this with the stocks or exchange traded funds in your portfolio. Just make sure that you have the cash to cover all of those below the buy limit orders, because if you don't, then you're either going to have to write a check or send in an ACH to your brokerage account to pay for everything, or you're just going to have to sell what you just bought because it turns out you didn't have the money to pay for it all. So I only recommend this to clients. I only do this for clients when I know there is ample cash to cover all of the purchases. So if I'm going to say, put a buy in 20% below where stock is now to buy, $50,000 worth of an exchange traded fund, the $50,000 has to be set aside in my client's account, or I'm not going to do it. Maybe if there's less money set aside in the client's account, I'll do it for less money. But you could get stuck buying all these below the market buy limit orders at once. It's conceivable that it could happen, and you just don't want that to happen to you. You want to make sure the cash is there. And if you decide you want to use that cash right now and deploy it into something, you want to buy something now, then just make sure you eliminate enough of your limit orders below the market so that if they do get hit, you won't be caught flat-footed and with inadequate cash reserves. Typically, I know for my clients and the broker, the Pershing, the clearing firm I use, open limit orders expire in a year. So I don't have to worry that I put some limit order in 5 years ago and now it's going to bite me in the butt today. They expire after a year anyway. But that is my strategy to buy in a down market, and especially a market where the situation is very fluid. There's still inflation. I don't think the bear market's over yet. I don't know for sure, which is why I'm doing a little bit of buying. But it's also why I'm not doing all of my buying today. You have to compromise. So, the war going on, energy, politics, there's so many things going on. I don't blame you for feeling negative. Uh, I don't blame you for having a negative outlook on the stock market and on investing if if your worldview is negative. And there's a lot to be negative about. I get it. But again, don't let your mind play tricks on you. We will have our cycles. Things will be good again. We will turn around in both geopolitics and everything else. Everything is a cycle. Don't let the cycles mess with your head and get you to do something with your investments that you will regret, 10 or 20 years down the road. People ask me what's my job, and I once said, my job is to help my clients watch paint for the next 30 years and prevent them from acting on their worst impulses of fear and greed. It's a pretty good description, right? If you think about what people have done, how they've jumped into pandemic stocks, the DoorDashes, the Zooms, the Pelotons, or the SPACs or the meme stocks. Think about that, right? How many people got burned on that? And think about how many people got burned when they sold all their stocks when the pandemic started in early 2020 because they thought the market would go down and stay down forever. You have a global pandemic. And yet that was the worst thing you could have done. So play your own game, invest according to your own risk tolerance, your time horizon, your goals, trust the process, and let the results take care of themselves. It's hard to do that when you're somebody who likes to control every outcome. But the thing about investing is you can't control the outcome. You can only control your actions, your steps along your financial journey over the long term. Thank you so much for watching. I'll be back tomorrow, and I hope you have a good night.